from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, global recession fears ramp up as the Federal Reserve struggles to tackle widespread inflation. The NASDAQ 100 leading the charge in tumbling U.S. stocks. Plus, potential layoffs, pay, and freedom of speech. It was all discussed at a virtual meeting with Elon Musk and Twitter employees. We're going to talk to a former Twitter insider about the future of the social platform. And crypto crisis, a conversation with Mike Novogratz of Galaxy Digital about when he expects this crypto winter to warm up. All of that in a moment, but first, fears of a recession mounting, sinking stocks days after the Fed's decision to boost rates. Tech right at the heart of it. Our Ed Ludlow here with more on the big moves. And Ed, stocks rallied yesterday after the Fed boosted these rates, then plunged today. What gives?
You have this real sense of deja vu. We've seen this before, a Fed meeting where they take action, stocks rise. Less than 24 hours later, look at the sea of red on the screen. You know, the tech, the real underperformer, the NASDAQ 100, very tech-heavy equity index, down 4%, closing at its lowest level since November of 2020, that session before the election in 2020. When I woke up on Thursday morning, we had the US 10-year yield at almost 3.5%. You're seeing yields come down 9 basis points in the regular US session to 3.2%. But another way of putting it is that's a drop of almost 30 basis points since the time I woke up. Now, granted, I don't sleep a lot. I've been awake for a long period of time, but these are serious move in yields that are clearly having an impact on the equity market. Bitcoin also caught up in this risk-off environment. Come with me into my Bloomberg. Look at this chart. Year to date, we've seen $24 trillion shed from market cap of equity indices all around the world. I bring this chart up because 50% of that comes from US equity indices alone. And of course, mega cap tech stocks have seen big declines. They have a huge weighting and outsized influence. Speaking of, back with me in the studio, these were really the underperformance of the market on Thursday. Mega cap tech stocks down really big. Tesla down 8.5%. News that they've raised prices, questions about global demand, questions about recession. As you said, Em, another stock that I'm watching, Twitter. All hands meeting, Elon Musk addressed staff. He talks about the future of the platform. He does not explicitly commit to the deal. He talks about ads and subscription models, charging to verify users, talks about potential layoffs based on merit of performance, talks about all kinds of stuff. Lots to unpick later in the show, but pretty buoyant stock in a down market, ends up closing down 1.7%, Em.
All right, Ed, thanks. We're going to dig into that Twitter meeting momentarily. But first, I want to talk about the markets with Carol Schleif, BMO Family Office Deputy Chief Investment Officer. So, Carol, how are you reading it? Up yesterday, down today. How do you make sense of it all?
It is definitely tough to make sense of it, but I think part of it reflects investors on a day-to-day basis. Yesterday, there was some exuberance, particularly over Chairman Powell's conversation after the actual Fed meeting and the Fed release in the press conference, talking about thinking that the number of 75 basis point increases might be limited. So markets got a little bit exuberant about that yesterday and relieved, if you will. Then flying into today, it's sort of like the morning after, and people decided instead of focusing on the glass half full, they'd focus on all of the half empty things and how much narrower that makes the Fed's ability to traverse and trying to stick a soft landing.
So at this point, are you thinking a recession is inevitable?
It may be higher likelihood, if you will. We weren't going into this necessarily thinking a recession was highly probable. Markets are discounting a 75% chance that you'll see a recession. We do think if you see one, however, that it'll be shorter and less deep than ever than we've seen in prior recessions. And so a piece of that relates to the fact that there is so much underlying business strength. And the other thing that goes pretty unsung is the fact that a lot of our companies have proven to be very adaptable and resilient and able to shift their business model, but they're facing a lot of challenges. And so the hope, everyone is waiting with bated breath to see if we're going to have that recession, but we don't think it would be sharp and deep.
So how is this impacting your approach to tech? Of course, we're seeing Apple, Tesla, Twitter, mega cap tech stocks sinking, some other narratives going on there, of course, with this Elon Musk Twitter thing. But how are you evolving your strategy when it comes to big tech names?
I think it's not just big tech names, it's thinking through technology in general. And typically what we've seen cycle after cycle over decades is that what leads going into a recession isn't necessarily what leads coming out. And so we might have to be more discriminating, figuring out where growth and technology comes. A lot of the growth in the new scenario, if you will be reshoring, building manufacturing, spending some of the $1 trillion in aid money that is still in the pipeline for infrastructure spend. That will require a different kind of technology. So it's going to require investors to think more carefully about where their technology goes. It's not necessarily just consumer-based tech, which played so well over the last couple of years of pandemic.
You know, we've been talking about the fact that Cisco, kind of like a poster child for the dot-com bust, hit its high before the dot-com bust and has since never recovered. What do you think are going to be the Ciscos of this generation?
It's tough. We're not necessarily allowed to talk individual securities, but I do think looking at industries that will support that reshoring, building of manufacturing, and the shifting of certain things like where individual people are in lower paid or higher risk jobs and you're automating. So robotics, artificial intelligence, sensors, lots of different things that are going to play into that new economy as we shift. It's not like technology as an entire industry needs to be written off or pieces of it, because much of it will still continue to play, but it's looking at where you're going to have that investment and what industries are likely to be able to play into the build out.
All right. Carol Schleif, thanks for sharing your views with us. BMO Family Office Deputy Chief Investment Officer. Appreciate it. Meantime, as stocks plunge and inflation rises, some companies are trying to lure customers with new features. T-Mobile just announced it is expanding its coverage to hundreds of countries around the globe and to flights. Let's get into that and how it fits into the macro environment with T-Mobile CEO Mike Sievert. Mike, always good to have you back with us. Tell us about this announcement and why you think now, with all of this going on, is the right time.
Well, let's start with now. Consumers are concerned, Emily, as you've been saying in this whole segment. And that's not just about the possibility of a recession that may or may not unfold throughout the rest of this year. Consumers are feeling the pinch right now. And our view is we can use the size and the scale of T-Mobile to help. And what's interesting is summer's here, and after 2 years, while feeling the pinch, customers want to get out there and travel. Travel's back, spending's up at higher than pre-pandemic levels in 2019. And so you have this dual force, a desire to travel combined with pinched pockets. And we're here to help. And so today's announcements are all about making travel easier for the tens of millions of T-Mobile customers everywhere.
I have to ask your thoughts on the macroeconomic environment. What do you see over the next 6 to 12 months? If Elon Musk has a super bad feeling about the economy and Jamie Dimon says we're headed for an economic hurricane, you've got the World Bank slashing their growth forecast. How are you watching all of this?
Well, I can tell you that we're in touch with our customers and they're concerned. And my view is our job when we have customers that are concerned about the economic situation is to be ready to help. And that's why we're doing the things that we're doing. And it's so different than the rest of the industry. Our competitors over the last month have, at this very moment, while consumers are concerned about everything you're asking about, have done $2 billion of price increases between them. And so it really showcases how different our strategy is. Ours is to look forward at what's unfolding, understand the concern consumers have, and pour value into our plans so that we can help them. And by the way, this isn't just altruistic. If we help them, it makes our most popular plan more popular, Magenta Max. And if that continues to gain popularity, well, that helps our revenues too, and everyone wins.
So you did raise some fees on millions of customers' wireless bills earlier this year, and I'm curious how, as we move forward, your plan to navigate inflation is evolving.
Well, one of the things that makes us different is that we have what's called price lock. And so what we don't do is take the fee that you signed up for, and during the term of an agreement with you is change your price, your ongoing price per month. And so that's really important to people right now. And by the way, our business as an industry and as a sector is a little different than some. We are probably more insulated from inflationary pressures as a company than many businesses in other sectors. You know, we have long-term tower contracts, long-term connectivity contracts, long-term technology contracts with our tech vendors. And so those things insulate us somewhat and allow us to do things like today's news. You know, we're pouring hundreds of millions of dollars of incremental value into Magenta Max and making travel easier for customers by doing something nobody has ever done before, which is put globally high-speed data right into our most popular plan at no extra charge. Plus, connect you on all of your flights for free on the most popular airlines, American, Delta, Alaska, and coming soon, United. No one's ever done anything like this before. And, you know, there's so much to today's news, but it's about making travel easier.
Now, we are seeing a number of different companies, hiring freezes, layoffs. Are you considering, are you having to make any cost-cutting measures? Do you have any plans like that?
We're executing our post-merger playbook. And by the way, I'll remind you, 2021 was the biggest growth year in our history. 22, the first quarter, was the biggest growth Q1 in our history on new accounts. And so we're executing our successful business plan. And obviously, over time, we have to be really smart about how we manage our company, and we'll do that. But look, this is a model that's unfolding exactly like we told investors it would unfold when we did our Analyst Day and laid out our 5-year plan last spring.
All right, Mike Sievert, CEO of T-Mobile. Good to have you back with us. Thanks for sharing the news with us and hear your views on the macro environment ahead. Meantime, the world's largest theater chain is once again branching out. AMC will create a $100 million fund to invest in other businesses. That's from CEO Adam Aron at the company's annual meeting. AMC's board approved this plan, but Aron didn't say where the cash will come from. In March, AMC bought 22% of Hycroft Mining, a gold and silver mining stock. Coming up, Musk stands his ground, tells Twitter employees the platform should allow, quote, pretty outrageous things. More on his virtual visit to the all-hands meeting next. This is Bloomberg. Elon Musk took questions from Twitter employees at an all-hands meeting addressing everything from potential layoffs to remote work to his vision for free speech on the platform. Musk didn't address whether he was committed to a deal to buy Twitter. We're joined now by former Twitter employee Claire Diaz-Ortiz, author of a book called Twitter for Good. She's also currently a venture scout at Kleiner Perkins. Bloomberg's Ed Ludlow here as well. And Ed, you were obviously covering the meeting in real time.
Right.
We had the contents of the meeting leaked to Bloomberg in real time. Just remind us what happened, what the flashpoints were.
Yeah, I think you're right to phrase it in that it's what he did not say, because
Right.
he had been billed and reported in the Wall Street Journal that he kind of outlined his interest in buying the company, you know, and he didn't explicitly say, I'm committed to this deal. But
He also
actually
wasn't explicitly asked if he was committed
And he was
to
not
buying.
explicitly asked. And basically how this works was Twitter staff were invited to ask questions through an internal Slack channel. Those questions were aggregated by the CMO, who then asked them to Elon Musk. But you know, he did give some really interesting insight into how he changed the platform. You know, he actually left the door open to advertising model, which was interesting because many assumed that the ad model wasn't good in his mind. He talked about subscriptions being good, but the one that really jumped out at me was this idea that he would charge users for verification, to verify that you're an actual human as opposed to a bot. And obviously, bots are top of mind for Elon Musk.
Claire, what do you make of, well, let's start with the business plan.
So I think, some of these ideas are great. The verification program, if you can call it that, has been broken since it was created. So
Right.
it'd be fantastic if someone comes in with some idea to fix that. And I don't know the nuances of if charging is actually a good idea or not.
Yeah.
But I think the larger question here is just I think all of this is sort of window dressing. I don't think Elon Musk wants to buy Twitter anymore, right?
His idea, if you don't mind jumping in, his idea was that if you charge people, and he didn't put a price on it, but to verify, if you run a scam or a spam or a bot organization where you have lots of accounts, he kind of talks about disincentivizing bots, that to make it so expensive that having a load of fake accounts is not worth its while.
Is that going to work?
Maybe it would work. I don't know. Twitter says they've got less than 5% bots. Other people say they have up to 15%. But is this relevant? I mean, isn't sort of this whole Elon Musk buys Twitter dumpster fire just kind of extending on and on and on?
What do you think?
I don't think he wants it. I mean, you have kids, I have kids. There are a lot of them in my house. When they want a cookie, they start throwing a tantrum, and eventually they don't want the cookie anymore, but they're still throwing the tantrum. I don't think he wants this.
So, today he says you should be able to say pretty outrageous things on Twitter, short of anything that breaks the law. Is that good enough as a content moderation policy?
That's not good enough at all. I mean, I think you've talked to Jason Goldman, one of my favorite bosses when I worked there, and he's, I think, said it best when he said that, if you take the guardrails off the platform, that in definition is anti-free speech because you're preventing a bunch of people from being able to say anything because they don't feel safe on it.
Mm-hmm. Talking to Twitter employees who are still there today,
yes.
I mean, how do they feel?
How do I feel for them? I feel sad. I feel very sad. These are very smart, wise people, supporting families, and they're stuck in the middle of this. And, I, like everyone else, makes jokes on Twitter all the time about it because it's so ridiculous and it just doesn't seem to end. But these are real people.
I think
right?
it's worth pointing out what Elon Musk said as well as it relates to the staff. The idea of work from home, remote work went over and over, and Musk made the point that if you do excellent work, you may have an exception to be a remote worker, but he kind of seems to suggest that it's not going to happen.
This is after Jack Dorsey had decided 2 years ago that Twitter employees could work from home forever. So that I think, at least in our reporting of the meeting, was the most disruptive part of it. You had the employee chat just lighting up with.
I mean, saying excellent work, that's like Silicon Valley code for saying, if you're the best bro, we'll let you work from home, but everyone else has to be in the office.
I think what's interesting for me, and I'd love your take on this, is he talks about what Twitter would look like as a private company, and compensation is a big part of that. He said it would be like SpaceX, where you have stock and options awards, a liquidity event every 6 months, which I think he means stock would be able to trade on the secondaries market. But Twitter is kind of like a San Francisco, Silicon Valley mainstay. It has a culture. How does that culture change?
I think the culture will change dramatically, but I don't think employees are stupid. I mean, at the beginning of this whole sort of journey, we all sort of, I think many of us thought this could actually be an interesting but crazy idea. Twitter stock has historically underperformed. All of us who are early employees have probably cried into our bank statements at some time that we, didn't work at LinkedIn instead or whatever. The stock has been performing really badly since it IPO'd. So I think there was some sort of a hope that maybe this crazy idea could do something good. But I think at this point it's just derailed.
So where does this leave Twitter? I mean, he has these lofty goals, get to 1 billion users. Again, we don't know if he's still really committed to buying the platform, but he's got a signed deal that binds him to buying the platform. Nobody knows how this is all going to play out. I think we should acknowledge there is a contingent of people who are super excited about Elon Musk buying Twitter, including some people at the company.
I think the very best thing that could happen in this situation is like I act with my toddlers when they're out of control. I think we can convince Elon he has won in some way by giving him something, but then making this all go away in some legal manner.
Something like what kind of something?
I don't know.
Well, he said he wasn't interested in the CEO role necessarily. He said he was more focused on product development than a title. But
from what you know about Twitter, is the bot thing as big a problem as he seems to think it is?
I think we all think that that's just cover for what's happening, right? I'm sure there's a bot problem. There always has been, but this is his out.
Ed, remind us what the next steps are, the time frame for this to actually move forward.
Standard deal stuff. Schedule a vote with the shareholders. You know, the board has given its unanimous approval for this deal at $54.20 a share. As far as Twitter's concerned, my understanding, they want to hold him to the terms of the deal signed April 25th.
All right.
Basic stuff.
Basic indeed, or not basic at all. And thank you, Claire. Thank you for sharing your very unvarnished view of the state of play. Thank you, Claire Diaz-Ortiz. All right, coming up, more Musk as Tesla hikes prices for the third time this year, and that story is next. This is Bloomberg. Now to a few other stories we continue to watch. Tesla has hiked prices across its lineup by as much as $6,000. This, at least the third price hike for Tesla this year. CEO Elon Musk said earlier this week the electric car company has weathered a tough patch the last 3 months, facing a months-long lockdown in Shanghai and supply chain snarls that have challenged production. And Musk and his companies, Tesla and SpaceX, were sued for $25 billion over claims they're part of a racketeering scheme to back the cryptocurrency, Dogecoin. A man named Keith Johnson is seeking to represent a class of people who've lost money trading in Doge since April 2019. He's asking for $86 billion in damages, plus triple damages of $172 billion, and an order blocking Musk and his companies from promoting Dogecoin. He also wants the court to declare Doge trading constitutes gambling under U.S. and New York law. Coming up, even in the era of free money, one startup had this advice: be frugal and drink Costco coffee. We'll have more on that startup next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Inflation, market turmoil, investors pulling back has many a startup tightening their belts and cutting costs. But there's one new unicorn that didn't wait for the downturn to be thrifty, or maybe it's savvy. Startup Vanta helps businesses protect against data breaches. Its co-founder and CEO, Christina Cassiapo, joins us now, along with David Sachs, a partner at Craft Ventures, who led the investment in Vanta. Thank you both so much for joining us. Christina, I'll start with you. You started off in venture capital, you worked in product at Dropbox, then you left to form Vanta. What is the problem that you're trying to solve here?
So really broadly, we're trying to help software companies be more trustworthy with their customers and build that trust. And so the way we do that is help those software companies improve their security and then go off and prove it. Often through something like a compliance audit, a SOC 2, GDPR, HIPAA, showing that they're taking these regulations seriously and really using them as an opportunity to build trust with their customers and ultimately grow their revenue and businesses.
Now, David, I know a lot of investors are being very careful about where they put their money right now. What attracted you to this company?
Well, Vanta is a company we've been interested in for a long time. We started to notice a number of years ago that many of our portfolio companies were using Vanta. We invest in a lot of SaaS companies, and we saw Vanta becoming a critical enabler for SaaS companies that want to sell into enterprises. Basically, if you want to sell enterprise deals, you have to get a SOC 2 certification. you have to do 27001, you have to comply with PCI and GDPR. And we saw that the market was shifting from using high-priced, expensive, and slow consultants to using a software platform like Vanta. So we've wanted to invest in Vanta for a long time. And when the opportunity came up, despite there being this downturn, we really jumped at the opportunity.
So, Christina, talk to us about this Costco coffee only approach. I mean, I love actually food at Costco, but I understand that you guys have been very conscious about, keeping costs down, even before we found ourselves in this macro environment.
Yeah, so you mentioned, so I was fortunate to start my career at an early stage VC firm and Union Square Ventures and learned a lot there. And one thing in particular was that investors prefer funding businesses that don't really need funding. And that just sort of informed how we've run Vanta from the early days, is to grow and be aggressive, but also do so with an eye to controlling our own destiny. And so one early example of that is we actually got to $10 million in revenue on just a seed round. And again, some of that were, hopefully prudent business decisions. And then there's a lot of things kind of like the Costco coffee that both help cut some costs that you might be spending otherwise, and are just a helpful cultural signal to folks that, hey, we're here to build a business. That's what's most important.
David, what's your advice to startups right now in this macro environment, all of this uncertainty ahead, people comparing this to the dot-com bust?
Well, this is clearly one of the top 3 worst downturns that Silicon Valley has seen in the last 20 years, along with the dot-com crash back in 2000 and then the Great Recession in 2008. And so I think this one is on track to be worse than 2008. I don't think it's going to be as bad as 2000, but I think founders need to be aware that we are probably headed into a recession. The capital raising environment is very different than it was last year. They need to lengthen their runway. We've been advising all of our portfolio companies to try and have at least 2.5 years runway, because you can't wait till the very end to raise. So if you want to have 2 years to work on your business, you actually need 2.5 years of runway. So we are advising our founders, cut your burn, do everything you can to survive this downturn. And I think, Vanta, one of the reasons why we wanted to invest is because they have been so incredibly capital efficient. What Christina did in terms of setting a frugal tone at the company, I think really worked. The company has one of the best burn multiples we've seen. That is our metric for measuring the capital efficiency of a startup. And so, VCs are we're still looking to invest in high growth companies, but we also want to see capital efficiency. And so the trick for founders right now is they can't just grow, they have to grow in a capital efficient way.
Christina, tell us a little bit about your fundraising journey, given all of the market dynamics right now, your own background as a VC. What was it like being on the other side of the table? Did you have any moments of panic where you were worried? Are we going to be able to close this deal in this macro environment?
So what I will say is that fundraising in 2022 was quite different from doing so in 2021. And kind of twofold, right? There's just more scrutiny across the board this year. And then a different set of metrics, right? In 2021, it was all about revenue growth and, kind of how much are you growing, how quickly. And this year, as David mentioned, burn multiple, big deal, right? So for every dollar of revenue you're bringing in, how much do you spend to do that? Gross margin, burn rate, runway, like all of these questions were just kind of not new for us, because we've been thinking about these things for the last couple of years and trying to manage them internally and keep an eye on them. But I think certainly different than the Series A we raised last year.
David, you've been building and investing since before the dot-com bust. And I'm so curious if you think a recession is inevitable at this point. If so, is it a recession with a capital R or a lowercase r? How bad does it get?
I do. I mean, I've been saying since February that I thought there were warning signs of a slowdown and possible recession. And now we have the Fed raising rates very aggressively. I think they waited a year too long. We had the warning signs of inflation a year ago, and they waited 9 months before doing anything. And now as a result of that, they have to overcompensate by raising rates very, very quickly. That's basically causing the economy, I think, to basically do somersaults. So I think we are headed into a recession. There's already a slowdown. We had negative 1.5% growth in the last quarter. So I think everyone should be, expecting a recession. And if it doesn't materialize, and I think probably a pretty serious recession, And if it doesn't materialize, that's great news. But I think that's what founders should be expecting at this point.
Which of the company, you're old enough to remember, and so am I, Cisco, hitting its peak in the dot-com boom and still hasn't recovered. Of, the big established tech companies that have enjoyed this ride, do you think any of those could become the next Cisco?
Well, I think the big public companies are in much better shape than they were. The big public tech companies are much better shape than they were during the dot-com crash. I mean, in the days of the dot-com crash, many of those companies were just kind of illusory. They didn't have real business models. They didn't have real customers. They didn't have real revenue. That's not the case today. I think what's happening today is that valuation multiples are changing. But these are real businesses. Software as a service is not going away. Software businesses are still incredible businesses. They're high gross margins. They're eating more and more of the economy. They're becoming a larger and larger category of spend by enterprises on software. So I don't think that this is existential. I think this is simply a big re-rating in terms of valuation multiples driven mainly by interest rates. And I think that what founders need to do is just make sure that they've given themselves the runway to persevere through a recession or downturn.
Christina, how do you think this is all going to impact the war for talent? I mean, obviously, you have employees probably thinking twice about whether they want to make a jump. Do workers want to work at startups right now, given the uncertainty?
Yeah, I think, look, there's a lot of doom and gloom that we talk about, with an upcoming potential recession. And, I don't think it's all bad news. I think, as we've both implied, like, downturns are when some really great businesses have gotten built. And I think it will actually become easier to recruit for the companies that correctly manage their burn and, stick around and are able to, not just persist, but almost accelerate through the downturn.
David, I have to ask you.
I would agree with that.
Go ahead.
I would agree with that. PayPal was largely built in the wake of the dot-com crash. My company Yammer, which we sold to Microsoft for unicorn valuation, that company was mainly built in the wake of the Great Recession of 2008. So downturns can be a great time to build enduring companies. The war for talent gets easier. There are fewer copycats getting funded, so the competition can be easier. The only thing that gets harder is fundraising. And so if you make sure that you raise money at the right time and you make that funding last, you lengthen your runway, then building during a downturn could be a great time to build a great company.
Well, I have to ask you about your former PayPal colleague and friend, Elon Musk. He spoke to Twitter employees at an all-hands meeting. We got some more details about his vision for Twitter, proposing the idea that all users get verified to crack down on bots, also saying that he believes folks should be able to say pretty outrageous things on Twitter, short of breaking the law. Do you think I know you've obviously been supportive of him buying the company, supportive of his ideas. What do you think is going to be most impactful about Elon Musk potentially taking over?
Well, I already see a lot of outrageous things on Twitter. So I think what Elon is saying is that he believes in the principle of free speech, and he thinks it needs to be applied in an even-handed way. I mean, we need rules created by Twitter that aren't just made up as they go along and that only affect one side of the debate. They need to be an honest, open marketplace of ideas. I think that's part of what he's saying. And then the other part that I hear is he's saying that Twitter needs to be a real business. He's saying that your costs now exceed your revenues. That's not sustainable. We need to cut costs. We need to grow revenue. It sounds to me like he wants to apply some business rigor to the company. And so I would expect that if he takes over the company, there will be some cost cutting. It sounds like, he believes in in-person work. He said that he would prefer that people be in the office, although exceptions be made for, truly exceptional cases. But I would expect him to apply some business rigor, and that's half of what he would do. And the other half is basically creating some predictable rules around speech.
Now, there are some doubts as to whether he's really committed to doing this deal, whether he's using bots. We had a former Twitter employee on earlier who believes he's using this bot issue to try to get out of it, that he's not really serious, that he doesn't necessarily really want it. Do you think is he serious? Is he committed to buying Twitter?
Well, the fact he did this town hall with the employees today actually is a sign to me that the deal is actually likely to happen. I agree that there was some question a few weeks ago about whether it was actually going to happen. But I think the fact that he did this meeting with the employees leads me to believe it's more likely than not that it's actually going to happen, that he intends to follow through with it. So, I don't know anything that he hasn't said publicly about it, but I would take that as a signal.
David Sachs, Kraft Ventures, and Christina Cacioppo, CEO of Vanta. Thank you both. Appreciate you covering a wide range of issues today. Okay, coming up, we're going to hear from Galaxy Digital founder Mike Novogratz on crypto's fall from grace and the sudden exodus of investors. He's next. This is Bloomberg. It is time for our crypto report now, and there's no end to the pain in the space as the rout in Bitcoin rolls on. Now down for 10 consecutive sessions. Galaxy Digital founder Mike Novogratz spoke earlier on Bloomberg Today about these headwinds in digital assets.
You have to hold crypto in context what's gone on macro, right? And we talked about there were going to be headwinds this year because the Fed was going to have to withdraw liquidity. And so assets that went up based on cheap money forever, if they're growth stocks or expensive watches or crypto, were certainly under pressure all year long. What's exacerbated this move in crypto is, a bunch of leveraged players that had far more leverage than I think people thought. And so you can talk about Celsius or 3 Hours Capital. That's caused almost something similar to what happened in 1998 with long-term capital management. Alleged, market neutral players with monster leverage, and that's being unwound. And that's created a ton of fear in the space. And so you've seen lots of credit being withdrawn from the space. And when credit's withdrawn, you've seen prices collapse. And so I had hoped this year was 30,000, 50,000 Bitcoin. And once we took out, 30,000, 28,000, we've cascaded.
Yeah.
20,000 is a pretty good target with 1,000 on Ethereum. We've tested that 2 days. When I look at the U.S. stock market, it looks like it's got probably 4% more to go to 3,500, which is where the 200-week moving average is, where support comes in. And I think you're seeing this liquidation of risk, and crypto's got caught up with it.
Mike, tough question, but did you directly have any sort of exposure to those counterparts that you mentioned, the likes of Celsius, the likes of 3 Arrows, or is it more third order effects that you gain the exposure, and is it systemic?
Yeah, you get exposure indirectly from any big player in the space, right? And when you have really big players that have borrowed money from all over the place, it creates this daisy chain effect. And I think that's burning through the system right now. My sense is it's mostly burned out. Like these fires go until they run out of oxygen. And so, you'd have to be one heck of a diamond-handed player to have sustained all of this if you have too much leverage. And so my guess is leverage has been knocked out of the system. But Humpty Dumpty doesn't, get put back together right away. It takes a while to kind of sort through. There'll be bankruptcy proceedings in many companies. And so I think while we should bounce off of 20,000 and bounce off of 1,000, it's going to take a little while for crypto to regain a narrative and regain confidence.
Galaxy Digital's Mike Novogratz. You can catch that full interview at Bloomberg.com. Coming up, inflation hitting customers hard, very hard. But is it changing their habits in buying clothes? We'll talk to Rent the Runway CEO and co-founder Jen Hyman about fashion evolution next. This is Bloomberg. Rising inflation and a looming recession have hit all sectors hard, but especially retail. But Rent the Runway was one of the few companies this earnings season to beat estimates and raise guidance. Joining us now, CEO and co-founder Jennifer Hyman. So Jen, how are you bucking the trend here?
I think the Rent the Runway is about delivering enormous financial value to the customer. So if you rent a dress for a special occasion from us, you're paying 90% off the retail price. And if you have a subscription, each item is like 18, 20 bucks. So it's even cheaper than shopping at an off-price channel. It's cheaper than fast fashion. And of course, it's the real thing. So we think that in an environment where we've been cooped up for the last 2 years, you're certainly seeing in kind of the earnings calls of Airbnb and Bookings.com and Live Nation that people are going out and they want ways to wear something new. They just want to do it affordably. So Rent the Runway is an experience that goes along with events and travel and going out to restaurants, going out to concerts. And that's why we've been able to perform.
There's no question, though, that inflation is going to hit folks even harder. People are paying more for gas, more for groceries. What's your forecast on how customer spending habits are going to change? How much are they going to be willing to spend on apparel versus some of these essential items? And how do they think about apparel? Is it more of an essential because we've been cooped up for so long?
I think that first of all, Rent the Runway has a customer base that's slightly different. It's more of a higher income customer base. So I think, listen, everyone is impacted by inflation and by an upcoming recession, and people are going to think about smarter ways to spend in the category. So I think the only data we really have is what happened in 2008. It was fascinating. In 2008, Americans continued to buy 65 articles of apparel per year, which was the exact same amount they bought in 2005, 6, and 7. What they did is they flipped into lower price per unit retailers. So they flipped into off-price, they flipped into value, and I really believe that re-commerce in general can now be part of that cost consideration set. So even in recessionary times, people still want variety in their wardrobes. Now, how does the fact that we all went through COVID factor into this? I think that this recession might feel different, might look different than the last one. I think that we may end up spending more on experiences in this recessionary period than we did in the last one because we didn't travel over the last 2 years. We didn't really go out to eat. We didn't see friends. And Rent the Runway is spend that tracks with experiences. So I think that you might travel, you have inflation, maybe you don't travel to Italy and you travel to Florida instead and you kind of book a cheaper hotel. You're still going to get out there and go out. And I think that as long as we can market value, we will be able to be more part of her consideration set.
Now, we're seeing a lot of tech companies have to make hard decisions, layoffs, downsizing. You had to make some tough decisions during the pandemic, and you've been very open about that. Do you have any reflections on that now and, potentially input for these founders who are having to make those tough decisions now?
We cut over 50% of our expenses in a 3-week period in March 2020. And it was a dramatic situation. In that one weekend in March 2020, over 50% of our subscribers paused or canceled. And so we had to act extremely quickly. We had to change the way we acquired inventory from buying inventory outright to actually revenue sharing and receiving our inventory on consignment. So I would say to other CEOs that there's not a moment to lose, that cash is king. You have to think about all of your investments and be more conservative. And kind of the great thing about this environment is it's not happening overnight. There will never be another experience where, like a pandemic, we're all locked inside, from March 8th to March 9th, we were living different lives. So we're constantly looking at the data internally, and we feel that we're able to react. And thus far, we feel positively. We gave great guidance for Q2, but reaffirmed our guidance for the year. We think that every business has to be smart right now because no business is recession or inflation proof.
So last quick question. If you beat estimates and you raised your guidance, does that mean the pandemic era of sweatpants is over?
Yes, a black tie to 2022 like sweatpants is to 2020. I mean, people are dressing up in a way that I've never seen before. They are bolder, brighter than they've ever been before. And I think that this is just the example, like they're dating again. They're going to parties again. Like people aren't going to stop doing that now. And so I do believe that this recession might be different for service-based companies.
All right. Jennifer Hyman, CEO and co-founder of Rent the Runway. Always good to have you, Jen. Thank you for stopping by. That does it for this edition of the show. We will be right back here tomorrow. I'm Emily Chang in San Francisco. This is Bloomberg.